The recent stock market crash has caused a lot of fear and panic. Personally, I've already lost over £8,000 in profits just in my Vanguard stocks and shares ISA, and it's actually more like £13,000 if you include my crypto portfolio, but let's not talk about that. Fear and panic loves to run wild when information is lacking, and it tends to result in very costly decisions being made that impact long-term returns. So to combat this fear that you might be feeling, I've spent far too many late nights researching all the most recent stock market sell-offs, with a view to see if we can identify how low this sell-off will go, when we'll reach this point, and when we'll likely recover from it. Let's jump into it. To understand where we're likely heading, we first need to understand why company valuations are falling in the first place. Based on all my research, there seem to be dozens of factors, but there's three key ones amongst them all that seem particularly prominent. The first is company performance. Some of the big headline companies, which were particularly successful during the pandemic, have started to struggle. Netflix and Facebook were notable companies which had to declare major declines in key metrics. For these two companies in particular, a core part of their valuation is based on their growth potential. This growth starting to decline has led investors to re-evaluate their investment thesis on these businesses, leading investors to value both Netflix and Facebook less favourably. This has then had a knock-on effect on the rest of the market, giving a more pessimistic view of the future, lowering valuations. The second factor is inflation. Both in the US and the UK, inflation is now not far off double digits, and it's actually expected to reach this mark in early autumn this year. You need to bear in mind that governments tend to target an inflation rate of around 2.5% each year, and they thought that following the pandemic there would be a short rise in inflation before quickly coming down, commonly referring to this as transitory inflation. They've now had to withdraw this terminology.
It's probably a good time to retire that word and try to explain more clearly what we mean.
As inflation is now nearly 4 times the normal levels and it's sustaining for quite a long period. This in turn is causing governments to increase interest rates, which dampen this. But changing interest rates is a very broad tool, meaning it has far more consequences than just the act it's being used for. Yes, it cools inflation, but it also makes debts more expensive. So any company which carries debt, which, let's be honest, is most of them, means they're going to be less profitable and as a result be less valuable. And talking about unintended consequences, the third of these key factors is the impact of interest rates on the choice of investments. Let me explain with this very high-tech graph. When investing, you have several different options with various levels of returns with a correlated risk. I say correlated as typically the higher the rate of return, the higher the level of risk. So let's plot this out on this graph with risk on the y-axis and returns on the x-axis. To keep it simple, let's just have 3 investment choices. The least risky is keeping your money in a savings account. You then have bonds in the middle, and then you finally have stocks. Some might argue that crypto would be even higher returns and higher risk, but let's not get into that right now. Well, the most well-known factor of these is your savings account rate. Let's say you're only getting 0.5%, meaning you're effectively losing money to inflation. Based on this, more people will move their money into riskier categories to get a better return, maybe into bonds or even stocks. But if saving account rates are more like 5%, it starts to make people question if the increased risk is really worth another 2 or 3%. Why not just play it safe and get 5%? So as you can see, as saving account rates increase, which are tied to interest rates, the more money tends to move away from riskier assets into safer havens. So think about it. Governments are trying to tackle very high inflation rates, and the only lever they can really use is by increasing interest rates. And when interest rates rise, saving accounts offer better returns, pulling money away from riskier assets like stocks. People know this, so as soon as inflation seems to be getting out of hand, people can see the writing on the wall and will typically pull money out of riskier assets, causing stock prices to decline. So that's the fundamentals of the situation. But the actual impact has been, and if we use the S&P 500 as an example, year to date we are just short of being down 20%, with a 16% decline in just the last 4 weeks. This means anyone who's purchased this index, so basically anybody who holds a global ETF like myself, is going to be down on anything that they've bought this year so far. A lot of unhappy and, more importantly, fearful investors. Right, so you know why we're here and what's happened. But a lot of my viewers wanted to know how low they think we might go. Well, the honest answer is that nobody knows, including me. But what I do have is several data sets which give me insight on the probable outcomes of where this sell-off might go. And based on this, I believe I can give you a reasonable guess on how much we're going to decline, how long it's going to take us to get there, and at what date we might establish new all-time highs again. So what's the likelihood that we're going to go lower? Well, luckily for us, Cesar Alvarez did some fantastic analysis on this back in 2019 to look at the frequency and depth of market sell-offs dating all the way back to 1929. Between some fantastic insight that on average there's 1.75% sell-offs or more each year on average, and there's actually a 21% chance that a 5% decline will turn into a 20% decline, we get this lovely chart. From this chart here, we can look at the probability of the market going either 20 or 30% lower after a 10% decline, with a 48% chance it'll go down by 28% and 31% chance it'll go down by at least 30%. But based on this, we can work out that if the market has already declined by 20%, which is pretty much where we're at, there's a 65% chance that we're going to have at least a 30% sell-off. So based on this data, we are more likely than not to go down at least another 11% based on probabilities alone. But come on, that's a little bit fluffy for me. So I went a little bit deeper and came across this beautiful table. Here we have a table of every single bear market since 1950. A bear market being classed as a decline of 19% or more from the top. In the last 15 bear markets, ignoring this one, we've seen declines ranging from just 19.3% and all the way to as brutal as 56.8% during 2008. But the average on balance is 30.2%. So this data actually backs it up again. That on balance of probabilities, if we've sold off by 19% already, then we've likely probably got at least another 11% to go. But you might be wondering when we're likely to reach this fabled 30.2% bottom. Well, currently we're roughly 120 days after our market top in early January. And based on the data so far, you might think that we've definitely got a decline to go, but there is some evidence counter to this. Over the last 15 bear markets, 6 have taken only 101 days to bottom out, meaning that it wouldn't be unusual if this is, well, the market bottom. But then again, we've had other occasions where it's been far more prolonged, 929 days in fact, a little less than 3 years. So on balance so far, it's likely we're going to decline another 11%, and we're likely to reach this point 338 days after the market top. That's another 200 days from now, and by my calculations, that puts us on the 8th of December 2022. So Merry Christmas. But that's just the market bottom. How long does it usually take to get back to all-time highs? Well, this ranges anywhere between a little over 3 months to nearly 6 years. Unfortunately, on balance, the recovery is likely to take much longer than the decline. Where the average decline only takes 338 days, the average recovery takes 603 days, a whopping 1.7 years. So based on our estimated market bottom on the 8th of December this year, that would put our break even all the way back to the 2nd of August 2024. But remember, I've based this all on the averages of the data out there. And let me be clear that there are examples where it's reasonable to think that this could already be the bottom of the market and it could all be up from here, but it is unlikely. Look, all this market data might make you feel a little bit deflated, but there are reasons to keep your head up. Let me take a comment that I've just had over the last few weeks, for example, and it reads as the following.
I followed your advice a year ago and bought VWRL.
Which, if you didn't know, is a broad global ETF, which I personally buy on Vanguard.
And it didn't grow at all. I'm doubting Vanguard is a good platform to put my money into. I'm disappointed.
Well, first off, let's ignore one, I don't give financial advice, never had, never will, so thank you for the free disclaimer. And second, Vanguard's platform has nothing to do with investment performance. The key part here is that this individual is upset that they only started investing 1 year ago, and as it stands, they have lost money on paper. Look, I do get this person's pain. After 2.5 years of my own investing journey, I'd invested £35,000 and all I had to show for my hard work was £31,000, a £4,000 decline in total. Just my luck, I thought. Why of all people did I start investing before a global pandemic? What are the chances? But to pat myself on the back, I kept calm, I stood the course, and I've been rewarded ever since. Skip forward 18 months later, and my £4,000 loss has turned to profits of over £18,000, so around about a £22,000 gain. And yet again, my resolve is being tested. as my £19,000 gain in Vanguard has quickly turned in just to a profit of £11,000. But there is data to explain why this happens. Here's data that plots out the likelihood that you'll be in profit based on the length of time you've been invested for. As you can see, there is a clear trend that the longer you're invested, the more likely you are to be in a profit. On the low end, if you've been invested for just one single day in the stock market, your odds of profiting are just above even at 52.5%. which is only marginally better odds than a slot machine. And after just 1 year, your chances increase all the way to 70%, and then 90% after 5 years, and then pretty much 100% after 15 years. But just look at how much opportunity there is to be in a loss. I would say that based on this data alone, it means that you're incredibly likely to be in a loss at least at some point in your first 4 years of investing. So you need to be prepared. Matt Damon once said,
"Fortune favors the brave."
Well, for me, this graph shows that fortune favours the ones that can relax, stay strong, and stay the course. It's as simple as that. So between now and the 2nd of August 2025, all I'll be doing is just that. Making money and investing monthly into the stock market come rain or shine. But if you're curious on how I plan on funding this, then this video here might just be for you. That's all for this video. See you in the next one.